Hi, Yassine from Change Wealth here to talk to you today about what is an index fund and how does that differ from the thing that people describe as a mutual fund. It's a pretty hot topic these days. If you ever turn on the TV and see ads from financial companies, this may come up, or if you're hearing various conversations about investing strategies, this may come up. So let's take a look at the key differences between the two and hopefully make more sense in the process. So the very first thing I'll note is that an index fund is not a separate thing from a mutual fund. It's actually a special type, so an index fund is a special type of mutual fund. A mutual fund, of course, is an investment fund that is made up of a bunch of different securities, financial instruments, and is commonly held by a bunch of individual investors. So it's a fund that is mutually owned by a bunch of individual investors. That's true of both a mutual fund, quote unquote, and an index fund. But let's look at what actually makes them different. The first is in the management style. So I'm going to write a couple words and then explain what they mean. So when people refer to a mutual fund as a whole, generally what they're talking about is an actively managed fund. Now, an actively managed fund is one that has a person, a fund manager, that is making the trading decisions, I guess, on behalf of the fund. So they are obviously, the goal is to try to deliver better investment outcomes than competing funds, for instance. And the way that is achieved is if that fund manager can pick winners, so pick this stock instead of that stock, or this bond instead of that bond. So picking winners that are going to perform well, or in terms of the timing of the trading decision, so buying and selling at advantageous times. Like if I had this marker and I wanted to sell it, flip it for a profit, I guess, I would look to buy it when it was cheap and then sell it when it was most valuable. So that's what the fund manager is in part doing in terms of the management of that mutual fund. On the other hand, an index fund is not so much managed by a person, but rather it's managed by an algorithm with the help of computers. So there's nobody here making trading decisions to try to pick, winners one over the other kind of thing. Instead, an index fund is meant to replicate the movement of the financial markets more broadly. So if you've ever seen like a graph of the performance of the stock market, of course you'll see lots of short-term volatility, little blips up and down in the short term, day-to-day, minute-to-minute even. But in the long run, there is an upward trend historically in the performance of the financial markets as a whole. And an index fund aims to basically replicate that performance. So it's still a subset of all of the various financial instruments available in the market. So it's a small subset, but it's a subset that's constructed specifically with the goal of mirroring the performance of the markets broadly. So what that means is that because up here there is a person making those trading decisions, and down here this is basically aided and enabled by computers, the cost, relatively speaking, of an actively managed fund is higher because, among other things, there is a person being paid to manage that fund, versus down here it's done pretty efficiently with the use of computers, that sort of thing. Now, that's not the end of the story, so there's no such thing as a free lunch. Some of the other implications of either type of fund are important to consider. On the mutual fund side, another thing that a fund manager can do, in addition to trying to pick winners and time the market, I guess, is to take steps to reduce downward short-term volatility in particular. So if that fund manager has some information that leads them to believe some portion of their portfolio is going to, or their fund is going to decrease in value, they may, for example, sell off some of the holdings. Like if a particular sector is expected to go through a downturn, that fund manager may sell off some of their holdings in that sector to avoid some of that downside volatility in the short term. There's probably a number of measures that can be taken to achieve that. But anyway, in the end, the short-term volatility, because of the active management, can actually be mitigated a little bit on the actively managed fund side, versus on the index fund side, because the portfolio is constructed to replicate the movement of the financial markets, it's going to go along for the ride. So if there's upward volatility or downward volatility in the short term, that index fund is going to mirror that performance accordingly by design. So anybody that can't afford to take on any short-term volatility might be well suited to be in an actively managed fund where a person can try to avoid some of that. But on the other hand, if we look at the long-term performance of the two, I should say that, it's not that a mutual fund can't beat the market, right? So if a fund manager does a great job picking winners in a particular year, absolutely, there are mutual funds that will beat the overall financial markets, beat the performance of the markets as a whole, particularly in the short run. So over 1 year, that's doable. There will be a certain percentage of mutual funds that achieve that. But the longer the time horizon, so say we go from 1 year to 5 years, it makes it more difficult, or it's less likely that a mutual fund with a person trying to consistently pick winners is going to outperform the market as a whole. So over a 5-year horizon, fewer actively managed funds will outperform the market. And over a 15-year horizon, for instance, the science and stats will show that there's virtually no instances of mutual funds outperforming the markets on a time horizon as long as, say, 15 years or more. So in that case, you'd be better off if what we're saying is in the long run, the markets outperform actively managed funds over a longer time horizon. You'd sort of be better off holding an index fund that is basically tracking with the performance of the markets as a whole. So generally speaking, the advantage of index funds is in the long run performance. Think of it, another way to think of it is like you'll see TV ads that say, mutual funds will whittle away the value of a person's portfolio with their fees. That's kind of figures into this. So for a mutual fund to outperform the market in the long run, that means it has to actually outperform by at least as much as the fees that are being charged to manage that fund, if that makes sense. Not that there are no fees here on the index fund side, but they're lower, which just means there's less of a hurdle to overcome in terms of the long run investment outcomes in that fund. So that's why you tend to have better long run outcomes in investing in index funds as opposed to actively managed funds, and the science will support that loudly. So it's not that there's a one size fits all approach for the common investor. If a person is in it for the long haul, they may find it advantageous to be invested in index funds. If somebody doesn't have a long time horizon, meaning they're at retirement where they're going to be, for example, they're at retirement where they're going to be starting to withdraw, maybe some of the protection on the short-term volatility is better for them. So the important thing is just to recognize the differences between the two types of funds. Hopefully this was helpful as a bit of a crash course, and we'll leave it at that for now. Talk to you next time. Thanks.